Welcome back. You're still watching Smart Money on CNBC-TV18, and this is a part of our Outstanding Women in Finance series where we're profiling women who have done their bit and have achieved it all in their arena. Today, of course, we have Jyotsna Singh of Kotak Private Wealth with us. Jyotsna, you were telling us before the break about how your investment mistakes or, your investment lessons, right?
Yeah.
You told us you need to stay invested, you need to stay patient, and that's the most important thing. What else? What else would you advise our viewer today?
So, another important thing to keep in mind really is know your own world. And, let me just sort of remind you of that famous story that we've all heard of when we were probably growing up about, Ganesh ji getting into a race with his brother Kartike. And, they decided to have this race and his brother, of course, went around the world 3 times and Ganesh ji just went around his parents 3 times and won the race. I think the clear messaging from that is know your world, know your goals, know your risk appetite, know your gumption to, to stomach risk, etc. And don't get bothered by what people are doing around you. I think somewhere we get really smitten by what others are doing around it. So don't worry about the Joneses, stay focused and once again, just sort of stay the course. And then, of course, you don't have to really burn your, or touch the fire to sort of feel the heat, as they say, because just keep observing what others are doing, learn from their mistakes, sometimes see what they're doing, sometimes see what they're not doing, and don't be in a rush to sort of jump onto the bandwagon, etc. And clearly, no FOMO. And that's something that we've really seen a lot of happening of late. So I think that's something we should be careful about.
Okay.
Just if I could sum up and say that one of the most important things, if you ask me, is the quality that you should have when you're, wanting to do investments. And more than intellect, I would say it is the temperament. Have a calm temperament, just stay cool about it. Ups and downs are, bound to come. That's the reality of the markets. But just hang in there and stay focused.
I'm very interested to know what is your own investment style, because this is a very dynamic market. It's hard to find sectors which stay the course, right? I mean, because of disruption, digitization, things are changing on the go. What is your investment style and how are you approaching the markets now?
Well, my own personal style is, I'd say, very vanilla. Now, I know that, vanilla is often misunderstood or understood to be plain,
boring.
Simple, boring, very rightly said, right? Maybe very safe and unexciting. But since you mentioned boring, let me just say that, to quote an ice cream expert on the word vanilla, he said it's a stunningly sort of complex and subtle spice. In fact, it's one of the most expensive, I think the second most expensive. But anyways, coming back to investments, for me, the vanilla part of investment, is sticking to the approach of asset allocation. I think that is really the cornerstone, and I'm a huge believer in it. And interestingly enough, and more studies have been done that demonstrate that over long periods of time, when you look at what has contributed to portfolio performance or portfolio returns, more than 90% plus has actually come in because of just sticking to the discipline of asset allocation. Now, asset allocation, as the name suggests, is no rocket science. It's about just sticking to how you want to diversify across various asset classes. Having said that, however simple and however vanilla this might sound, the reality is, and I can also speak for myself, it's really difficult to actually adhere to it in a disciplined fashion. Sometimes it's just lack of time. Sometimes it's you just get a little emotional about, I bought something and all sorts of, colorings come into your judgment. And
but
that is why.
Let me ask you this. Sorry to interrupt, but I want to ask you, when you talk about vanilla, right? What is the basic fundamental of your investment journey? Do you prefer buying, say, just going with large cap basket buying in terms of stocks? Do you prefer putting all your money in ETFs, index funds? Do you, like a little more aggression with mutual funds? Because we do know that at the end of the day, mutual fund managers, they have not outperformed the index funds, right? They haven't outperformed the benchmark. I mean, that's the truth. So how are you approaching it?
I think it's a very pertinent question you've asked, and that is why I was saying that when you stick to asset allocation, once you're clear on that, and asset allocation could depend on one's own age, goals, risk appetite. I keep harping on risk appetite because, again, yours could be absolutely different from mine. But having said that, one can either do that by one's own self in terms of constructing the portfolio. But these days, there are very interesting platforms that are available. And again, I'm a huge believer in using those platforms where they're actually asset allocators for you. So once you give them your risk profile, they will go ahead and do, once they know, for example, that if you're an aggressive investor, they could do an 80-20 for you, etc. And then they will decide whether how much should go into active, how much should go into passive. You talked about ETFs, which would be, in the passive part of it. How much should really go into large caps, how much should go into. So it's all taken care of. And the beauty is that very often, we don't stick to asset allocation or the discipline because, like I said, time constraints, we get a little, emotional about stocks. Whereas here, it's done as a process. That's the bread and butter living, and it's very clinical. So I'm a big believer in going to the platforms and allowing them to do it for you. And I know many people would say, oh my God, you're a finance professional doing it yourself. But it's true, professionals don't have that much time to
do it themselves.
Yeah. And of course,
I understand. I feel the same, exactly the same. I mean, you can leave it to the professionals who do it daily, right? Why do you have to do it when you have other things on your plate? Let's talk a little bit about your lessons, right? Because you have had a career of over 35 years. I'm sure you've met a lot of stakeholders of the industry, whether it's market guys, corporates, and I'm sure you had some mentors, some role models as well. Who has your role model been, Jyotsna, and what is your biggest learning from them?
There are many investment gurus and of course, domain experts that one has learned from a lot. Many colleagues in the industry and within the workplace that one has gained immense insights from. But since you specifically asked from an investment perspective, I would say for me, personally, someone that has done both wealth creation and more would be a sort of a role model. And for me, that would be the House of Tatas. Because, someone who's actually been in the real economy and has managed to touch the lives of so many people, the kind of job creation that's happened, the kind of impact they've had on society, the kind of reforms that have come in because of them, whether it's land reforms, whether it's labor reforms and social reforms, etc. They have made such a deep impact, and at the same time, they have generated wealth. So I think it's a win-win. Somewhere there is this debate that happens even when you talk about sustainability, etc., that can businesses be profitable if you need to be sustainable? And I think the two are absolutely interlinked. And, the Tatas are such an awesome group to look up to and see it. And if also, if you look at the numbers in terms of how their stocks have done and you compare it, there's enough and more data again out there, but about a 26 year analysis comparing some stocks across Germany, Japan, US, leading countries, and then of course, Warren Buffett's own Hathaway enterprise, and then the Tatas, the numbers clearly stack up in favor of the Tatas over longer periods of time.
That's great. Okay.
So, point being, they've done well financially, that basket of Tata companies, and yet they've done so much good for society. So my vote would go to them.
Okay, your vote would go to them. We have just a couple of minutes left. So let me ask you, for a viewer who's, perhaps watching you right now, looking for their own investments and to grow their corpus. You spoke about being patient and, investing in this market, being consistent with your investments. Sure. In terms of asset allocation, do you believe that for someone who's young, say between their 20s and 30s, does it make sense to diversify outside equities? Because this is a time where interest rates are also on the rise. In fixed income, there's a lot of interest now in fixed income. Your views there. What about gold, other asset classes at a time when perhaps there's a recession looming in the US? Your thoughts?
So, when people look at asset allocation, and so let me again sort of look at it from my own personal lens, equities is clearly something that, most youngsters, and I also started pretty young as far as equities went. But I didn't sort of ever give up on fixed income because, the kind of comfort or the little bit of safety pot that one wants to create can be created quite easily and conveniently through fixed income. So I don't think I was ever 100% equities and zero debt. I always had something in fixed income. And I want to say that ratio has changed over the years, but very consciously. You're talking about equities and fixed income. Another very interesting asset class that has come up is that of alternates. And therefore, if you look at, say, things like REITs, or you look at, you mentioned gold, it could just be, any other real estate that one is looking at, hedge funds, long shots, all of that has also become a very interesting class. But again, while we typically talk about age, et cetera, and risk-taking ability, the truth is, and the honest truth is, that when people do their risk profiling, they might think that they're very aggressive, but very often they do not have the ability to stomach volatility. Okay. So I don't want to do any stereotyping here that, in your younger ages, you should do this and you should not do that. I think it is different folks, strokes for different folks, and no one's sitting on a seat of judgment. But yes, very often equities, just because by its very nature one likes to invest for a slightly longer term perspective, the earlier you get in, the better. And might I just add, we should not forget what Einstein has taught us, and that is the power of compounding. And he calls it the 8th wonder of the world. And I may have said this on your show earlier, but I truly believe in it, that, those who believe in it benefit from it, they earn it, and those who don't pay it. So just remember the power of compounding, and it only comes into play over longer periods of time.
Okay, on that wise note and on those pearls of wisdom, we will let you go. Thanks a lot for joining us, and all the best. You've had a great journey so far, and hope you continue to reach new heights. Thanks a lot, Jyotsna, for being with us on Smart Money.
Thank you, Sonia. Been a pleasure.
Well, with that, it's curtains down on another edition of Smart Money. Thanks a lot for watching.